Hello, everybody. Welcome back to the interview. I love meeting with these entrepreneurs across Houston. And as you know, we met with Tom Brodie earlier. He shared a bit about cost segregation and how it can be of value to people, especially commercial business owners, is really where the value is. Now, let's talk to Tom again. And he's back with us. And the main reason is he informed me there's some windows of opportunity here that one may want to take now. So time is of essence, and when you're dealing with money, the sooner you have it in your bank account, the better it is. So Tom, welcome back to the interview.
Well, thank you very much for having me. Pleasure to be here.
More than my pleasure having you on here. So listen, after our last meeting, you shared with me some PowerPoint and some details about why cost segregation should be looked at earlier than later. And what I'd like you to do, you have screen share capability, kind of like you to give us a little less of a Q&A this time, a little bit more of a presentation.
Okay.
Why should somebody start cost segregation now?
Great. What I'd like to do is I'm gonna share my screen here. There we go. So cost segregation is all about breaking down your building into component parts that can be depreciated quicker, right?
Okay.
Right now, everybody, if your CPA is doing it, it's going to take your building value, put it in a bucket, right? And that bucket is just one bucket. Yeah. So it's either 39 or 27 and a half years, 39 for commercial, 27 and a half years for like apartments. Okay. But cost segregation is going to break it down into different buckets. So you've got your base building, right, which is a 39 or 27 and a half years. That's structural, so you can't accelerate that. But there's things inside your building that you can accelerate. So you've got things called a tangible personal property. That's either 5 or 7 years. Then you've got the things inside walls, all that stuff. It's now called qualified improvement property, or QIP. It used to be called leasehold improvements, right? Okay. Then the other one is land improvements. So to give you, so the great thing about breaking it up like this is that it takes advantage of some recent tax law changes, specifically what's called 100% bonus depreciation, which applies to anything less than 20 years. So it's these 3 buckets in the circle. So anything less than a 20-year life is eligible for 100% bonus depreciation, which means you can write off its entire value right now, after you've done a cost segregation study, to be able to identify what those different buckets are.
So let me interrupt here. So if I'm following you correctly, most accountants, most accounting, I don't want to really pick on the accountants because they're doing the best job that they can, but most accounting is taking depreciation over the 39 or 27 and a half structure. They're not getting into the detailed items of tangible personal property, QRP, and land improvements. That's where the opportunity is here, is identifying these under 20-year depreciation schedules that you can then break out from the overall generic depreciation. Am I saying that correctly?
Absolutely. I mean, it's one of those things that your CPA, your accountant doesn't have the time or the expertise to get into the details and break that out, right? What they'll do is they'll look at maybe furniture, fixtures, and maybe floor covering, because that's easy to identify, how much you spend on carpeting and whatnot. But the things that go into the building, like molding and all that stuff, they don't get into that detail. So let me show you real quick, just kind of give you an idea of the type of things we're talking about. The base building, that's structural, your foundation, your exterior walls, the basic plumbing and basic electrical. But then you've got some tangible personal property that's in the 5 and 7 year category. So that's decorative items, like carpeting, countertops, special electrical, special plumbing. Think of a dentist's office, right? The exam chairs that used to be in all used to have a little sink right next to it. That's specialized plumbing. You've got specialized electrical. A lot of times X-ray machines need a dedicated circuit. So that's above and beyond what's in a normal building. So those kind of things can be readily identifiable if you know how you're looking at it. The thing that used to be called leasehold improvements, which is now QIP, qualified improvement property, think of that as what somebody might build out if they're building out a lease space. So it's like sheetrock, special flooring, all that. So that pertains to lease space, but also it's the same kind of category for a building that you own. You build out the different offices, like to have sheetrocked walls and things. Then land improvements, this is where a big expense comes that people don't really realize, unless they own a building, the parking lot is a tremendous expense to build that compared to the building, because it's just sitting there, right? And you got cars parked on it.
Right.
But that's a 15-year property. If you can write that off right now after doing a cost segregation, that's a huge value. So it's these kind of things that are out there that a cost segregation study will break out into its component pieces.
Got it. Got it. Now, you had mentioned when we spoke the other day, there's a timing issue here, something about 2017, 2019, you know.
Exactly. That's the next thing. This 100% bonus applies to any building that was purchased or bought after September 27th, 2017 through and before January 1st, 2023. Okay. So the whole bonus depreciation thing is going to start phasing out. I mean, that's why I think the current administration is not going to touch it, because this thing's going to go away. You know, it's not a permanent tax credit or tax incentive. So after 2023, it starts ratcheting down 20% every year, right? So that's why you want to take advantage of this as soon as you can, because anything that you buy after into 2022, you're only going to get 80% bonus depreciation. And then as it goes further into time, this thing's going to actually phase out until it goes away.
Sure. So the action is now.
It really is. I mean, it's one of those things, if you haven't heard about this and you think it may apply, it's worth a conversation, because we can tell you right now, based on some really high level information, what we think we can save you. And you may not have any idea of 100% bonus depreciation. I talk to accountants and CPAs all the time, and they have a little bit of an understanding, but they don't truly understand it. They think they get it tied up with something else, like Section 179. And again, the IRS code's only 75,000 pages long. Nobody's an expert in everything.
You betcha. Now, process here. So somebody who may not have their CPA on call or their bookkeeper on call, what are they going to need to bring to you to get this ball rolling, to see if there's any value for them?
Really high level information. So I'm not asking to get anybody's books or anything. It's how much they pay for the property. Either they purchased it or they built it. When did it go in service? Like the month and year it went into service. What did they put into the property since they bought it? Renovations, those type of things. And then an address and a brief description, like a 2-story office building with X number of square feet. Those things let us look at all of our studies that we've done nationwide and come up with an analog for their building. So we know if we've did a building similar in another state, and say, what, we can save them pretty much the same kind of money, because it's a very similar looking building.
Interesting. And then they decide to move forward with you. Is there a cost to them to move forward with you? How's that work?
Well, once we give them an estimate based on those 4 things we talked about, we'll actually show them what we think we can save them, and we'll have our fee set, and it's a set fee. So even if we find a lot more money than we thought for the customer, our fee doesn't go up. So it's a set fee based on the whole building cost. Got
it. Very cool. Now, you had sent me over some slides, a little more detail on maybe some of the actual schedule. Is that something that you wanted to share here?
Yeah, absolutely. That's one of the things we'll go into.
Too far in the weeds.
Yeah, well, it's one of these things that makes a lot of sense when you understand it. And let me go in here and we'll get past that. It's a thing called the Tangible Property Regulations of 2014, and this is getting kind of technical, but the thing that where this becomes important is that up to now, the IRS has not enforced this. They didn't have the time, the effort, the manpower, whatever. But if you're thinking about the current administration looking for money, looking for revenue, this is going to be the low-hanging fruit. So the Tangible Property Regulations, what that says is that unless it's all about building systems, right? And that's one of the outputs of a cost segregation report that comes from CSSI, is we break down your building into building systems. So tangible property regs say that if you make an expenditure to a system and it's not making that system better, more efficient, or if it's not a 30% of the total system expenditure, you can expense that versus capitalizing. So the depreciation schedule you'll see on the screen has got some highlighted examples of things that I think are suspect, right? If you've got a sewer improvement at $15,000, again, if the total sewer system is say $100,000, then this $15,000 expenditure is not above 30%. So unless you're making something really more efficient, that's something that can be expensed, and you need to take it off your depreciation schedule. Because if the IRS sees this, and they may see it like during an audit, this is the first thing they're going to look at. They'll say, okay, that should have been, that's in non-compliance with the tangible property regulations of 2014. We're going to disallow that depreciation.
Interesting.
Which means now you owe more taxes.
Right, right, right. This is interesting.
So that's one of the services that we perform when we do a cost segregation for a client. We look at their depreciation schedule, and this really applies to someone who's had a building for a number of years and they've put a lot of money back into it. You know, a lot of people had kind of a rule that says, hey, if we have an expenditure over X dollars, we're going to have to capitalize that. Well, this tells you not necessarily. Depending on your system cost, if you're not making it better, you can expense it. And if you've put it on your depreciation schedule, you're in non-compliance with the tangible property regs, which nobody knows about. And the CPAs really aren't talking about it because they know that the IRS has not been enforcing this. And so why would they spend the time worrying about it?
So on one side, let's not, create fear and saying that
No.
an audit on you, but the reality is this is an opportunity to find some more money for you.
Absolutely.
Get into compliance, of course. But
absolutely.
If they can accelerate or use this cost segregation to identify more dollars to put into your pocket now, what could that money be used for? I mean, the beauty about this is there's no restriction as to where the money can be used, correct? It's not like—
That's correct. It's their money. I mean, it's kind of our tagline, it's your money, keep more of it.
Sure.
But the great thing about that building systems report, you can use that going forward. So now you've got a building system definition. So if one of your AC compressors go out, you say, okay, I've got a system value of $100,000. I need to spend $5,000. That's not 30%, and I'm replacing it with a like kind compressor or condenser. That's not something I have to capitalize.
So we can take that. I get that. That's interesting, illogical. It makes sense, but I guess it's getting in the weeds and seeing those numbers and making sure that you're taking advantage of what's available to you through this cost segregation policies. These are great. Tom,
Absolutely.
is there anything else you wanted to share with us in this quick one here today?
Yeah, one of the things that has to do with the depreciation schedule also, and where that comes into play is in the depreciation schedule itself. If you've got things on the schedule that are showing a 0 book value, and if you see the things in the red circle, these are on your schedule, but they have no additional book value because they've been fully depreciated. You need to get those off your schedule. And where this comes into play, if you go to sell the building, that in this case, that $117,000 on your schedule is going to be part of your tax basis, or the cost basis that is going to be compared when you sell the building. So if it's on there, you may have to be paying a tax differential on that.
Interesting.
The great thing is, if it's 0 value, get it off your depreciation schedule. And a lot of times what I found is that building owners don't see their schedule. It's not something that has to be submitted with your income taxes. So it's usually something that your CPA or accountant holds on to, because they report information off of that, like how much you're taking in depreciation, but that doesn't require the schedule to be submitted with your tax return. It's a separate little schedule. It says this is the amount of depreciation, and that's it. So it's those things that building owners really need to look at the schedule. And again, that's something we'll look at when we're looking at doing a cost segregation on a client's building. Look at the schedule, and we'll point out some things that they need to clean up just so that save them money in the future.
Well, this is fantastic. And the takeaway there is, as boring and as painful as it may be to look at those depreciation schedules, look at them.
Absolutely.
And don't be afraid to just take a few minutes and see, are there zeros here? Okay, great. Call Tom.
Or, just have one and send me the schedule, and we can take a look at it there. No additional, no cost. And say, we think we can save you money, and then we'll get into the details then. But if it's looking good, I will tell you it's looking good. You're fine.
It's fantastic. Well, Tom, I'm glad that you came back so quickly and shared this detail with us now. A little more meat on the bones, if you will. We're able to, hopefully somebody watching this will be in a position where they have a building either recently purchased or maybe a few years here, even long-term, doesn't make a difference. Get into these depreciation schedules, get into this conversation with you to
Absolutely.
determine if there's money to be found here for yourself. Take the money now. Like you say, it's your money. Keep more of it.
Yeah, especially for someone who's leasing space. Like a lot of times doctors will do that. They lease space in like a strip center or something, but they spend a lot of money in the build out. And that's that money now, especially if it's after that September 27th, 2017, that's now been identified as something that you can accelerate the depreciation on. It's no longer just a sunk cost, it's an asset. And so let's treat it as such and lower your income taxes.
This has been fantastic. There's a great wealth of knowledge. I hope you come back. I hope you're willing to come back on the interview
Absolutely.
and give us some more details and how this works. We like keeping these short and sweet, enough for people to say, yeah, I need to talk to you. Here are some of the details. Let's roll. So I thank you. We'll get this out into the verse as soon as possible. People know how to find you. Your phone number is listed here. They
Yep.
can QR code you if they have their phone up there.
Absolutely.
So I won't even ask you to repeat it, and I'll just make sure it's on our video. Tom, I thank you
Okay.
for your time here today.
Great. Thank you very much. I appreciate it.
That's just mine.